Chasing a fast shortcut to wealth usually guarantees burnout. You end up running on a treadmill, burning energy without gaining any actual traction. Ambitious people look at the Forbes list and try to copy the surface-level tactics of billionaires, but they fail because they ignore the underlying financial structures those individuals use to build their wealth. Take Elon Musk. He consistently raises outside capital to fund and grow massive visions. Mark Zuckerberg executed the exact same strategy to map out global social networks. Then look at Sam Walton. He built the Walmart empire with the opposite approach, funding the business through his own cash flow and reinvesting profits. These operators play a completely different game. The path they took was dictated by a specific combination of where their capital came from and who owned the asset. This chart breaks down your options. First, you have to determine whose money you are using to grow, your own savings or other people's money. Second, what exactly are you building? Are you running your own business, or are you buying into other people's businesses? The intersection of these two questions creates 4 distinct paths to mega money. To reach the top, you have to audit your current resources, pick the exact quadrant that fits your life, and commit to its unique rules for an entire decade. Let's start in the top left. Bootstrapping. This is using your own money to build your own business. You fund daily operations through your personal savings and the cash flow the business generates. Because there are no outside investors, you dictate the strategy and retain 100% of the equity. Michael Dell built his computer hardware empire using this exact model, trading his skills and cash for early inventory to get off the ground. The limitation here is sheer math. Your growth is severely capped by how fast you can generate profits to reinvest. Because you have to build the machine that makes the money while simultaneously building the business itself, this is the slowest path available. You avoid financial debt, but you incur massive invisible debt. Without the capital to hire a star team upfront or build premium infrastructure, founders accrue severe leadership and technical debts that restrict scale. Even with the speed limit, bootstrapping is the smartest choice for a first-time founder. It forces you to pay down your own ignorance without risking your friends' and family's capital on your learning curve. Moving to the top right, we have raising capital. You run the company, but you leverage outside money to scale it. You take this path when your vision demands massive upfront costs. If you are building physical manufacturing plants, pushing pharmaceuticals through clinical trials, or chasing a winner-take-all network effect, you will bleed cash for years before generating profit. Jeff Bezos utilized investor cash to intentionally lose money for over a decade. He outspent competitors to capture the market before focusing on margins. That raw speed extracts a heavy toll from the founder. When you trade equity to fund rapid growth, you severely dilute your own ownership. Because of terms like ratchets and liquidation preferences, the investors get paid back first. A founder can exit a massive company and walk away with a surprisingly small sliver of the total pie. Operationally, you now serve 2 competing masters. You must please your end customer while hitting the aggressive return targets of your venture capitalists. In fact, it is entirely common for founders to be outvoted and forcefully removed from the boards of their own companies. Raising capital allows you to pursue rare, global-scale opportunities. You just have to accept that you are trading personal sovereignty for raw speed and scale. Down in the bottom left is investing. You deploy your own money into other people's businesses. You step completely away from day-to-day operational duties. You take excess cash generated from an active income source and buy into diversified assets like public stocks, cash-flowing private businesses, or real estate. Warren Buffett mastered this specific quadrant. He acts as the capital allocator while others run the businesses. The harsh reality of pure investing is the extreme time horizon. The vast majority of Buffett's net worth accumulated after he turned 60 years old. Compounding interest demands an immense amount of time. The math dictates that the curve will stay flat and boring for decades before it finally turns exponential. You must already possess a high active income to make this work. Without a large initial principal to feed the machine, the percentages won't generate meaningful total dollars. Investing offers the easiest lifestyle, 0 bosses and no operational fires to put out. But to reach the highest tiers of wealth, you need a flawless 40-year time horizon. Finally, the bottom right is fund management. This is using other people's money to buy other businesses. This provides the most extreme financial leverage possible. You put in a tiny fraction of your own cash, say $5 million. You raise $95 million from limited partners. You take that $100 million pool, add $200 million in bank debt, and suddenly you have $300 million of buying power. Assume you hit moderate growth targets. In 7 years, that portfolio doubles to a $600 million exit value. When you cash out, a strict payout waterfall kicks in. You pay back the $200 million to the bank, then return the limited partner's principal and hurdle rates. The remaining upside is split between the investors and you. Your original $5 million check just yielded tens of millions in personal payout. You earn that leverage through severe stress. You take on massive regulatory oversight, a 7-year illiquid feedback loop, and the constant pressure of safeguarding other people's life savings. Fund management is the ultimate wealth multiplier. It is strictly reserved for connected operators who already hold a proven track record and proprietary deal flow. Creating massive wealth requires accepting a basic rule. You cannot have maximum control, maximum leverage, and zero risk all at the same time. If you are a first-time operator, build your foundational skills in the bootstrapping quadrant. Learn to survive without risking other people's money. If your vision requires heavy infrastructure simply to exist, you must step into the raising capital quadrant and embrace the dilution. If you generate high active cash flow and want a decentralized lifestyle, lock into the pure investing quadrant and let decades do the heavy lifting. And if you are an industry veteran with a proven edge, step into fund management to access the absolute highest financial leverage. No president and no macroeconomic trend will grant you wealth. You have to build the structural vehicle yourself. Look clearly at your resources. Identify the single quadrant that matches your risk profile. Accept the unique costs of that path and relentlessly execute for the next 10 years.